Are these Dave Ramsey's 4 recommended funds? I think it's probably probably. Now, I don't know for sure. I don't know what his funds are. I never hired one of his guys. But if these are the funds or pretty close to it, I'm a fan. No other way around that. No other way around that. So we'll dive into these and see what you think and let me know. And if you have an experience with Dave Ramsey and his group there, if these are his funds, say yes. If not, say no. It'd be interesting to find. So Dave Ramsey recommends 4 funds: growth and income, growth, aggressive growth, and international. I don't know really how you differentiate between aggressive growth, and growth and income. I mean, in some ways I do, but in other ways, aggressive growth is, think of this as a category of the wild child of your portfolio. When these funds are up, they're up, and when they're down, they're down. Aggressive growth funds usually invest in smaller companies, so small caps are going to qualify. Even a mid cap that invests in small to mid-sized companies. So aggressive growth will be smaller size. Here's growth. This category features medium and large U.S. companies that are experiencing growth. Okay. Unlike growth and income funds, these are more likely to ebb and flow with the economy. For instance, you might find the company that makes the latest IT gadget or luxury item in your growth fund mix. Common labels for this category include mid-cap, equity, and growth funds. Okay. Growth and income are the boring funds of big, boring American companies that have been around for a long time. Okay. And then international funds are, international funds. You may receive these referred to as foreign or overseas funds. Just don't confuse them with world or global funds, which group U.S. and foreign stock funds together. Good. All right, so let's see. Now, I will say, I think Dave does recommend paying the guys his ELP's commissions as opposed to fees. I don't know that for sure. I was just reading a couple things before I did this video. And if that's true, I like that. I think if you're going to hire somebody, pay a commission. Absolutely. On the front end and be done with it. They're going to have these trailing fees called 12B1 fees, which you will never see. You don't get invoiced for, but they're 25 basis points, 1/4%. And that's fine. I got no qualm with that whatsoever. If you want a guy that you can go to on a regular basis to talk about your stuff, you paid an upfront commission, and now you got a person you can run some ideas off for 25 basis points. I got literally no problem with that. I'd rather have you do that, frankly, than do the fees, the 1% a year, or 1.25 or 1.85, heaven forbid. Absolutely, I'd much rather have it pay a front end commission. You can run the numbers, and it's not even debatable what's going to outperform for sure. All right, so let's dive into what I think are his funds, and I'll show you. You won't be able to read this, but I wrote it out. And what you'll see is, I think, is AIVSX. That's the Investment Company of America. We have the Franklin, FKINX. That's the Franklin Income Fund, Class A. Investment Company of America is Class A. We got CWGIX, which is Capital World Growth and Income Fund. And then we have the Fidelity Contra Fund, FCNTX, which is actually the Fidelity Advisor New Insights Fund. So we'll go over to each of these. These are all going to be Class A shares because you're going to pay a commission to his guys. Commissions are not as evil as what the holier-than-thou registered investment advisory world would have you believe. Commissions are actually much better than paying a 1% annual fee, for sure. It's not debatable. Seems like I have something else I want to... Oh, Dave also talks about how his funds have been around since 1930s, since the 30s and 40s, and they've averaged 12% a year. That's why I have to think he's using the two AIVSX, which is the Investment Company of America, and the Franklin Income Fund, because those have been around for a long time. The CWGX, there's been no international fund that's been around that long, just none. And then Aggressive Growth Fund, I don't know what it could be that's been around that long, that's done 12%. I just don't know. I don't know what it could possibly be. So I'm using the Fidelity Contra Fund, and then the Bill Danoff started their advisor fund, called the New Insights. I have to assume that's what we're using here. But, that's one. The two I don't know what he's using are going to be the international and the aggressive growth. I don't know. But I'm presuming if it's international, it's going to be American funds because they're freaking awesome. And then the Fidelity Fund. So we'll see. But anyway, let's dive into this. And if I'm right, these are good portfolios for sure. All right. No other way. Look, if I'm right, there's no getting around this. This is a good investment mix. It's aggressive, but perfect for the barbell approach, without question. All right. Oh no, Investment Company of America only gets 2 stars. Oh, what are we gonna do? What are we gonna do? Well, I mean, Dave's right in this regard. I can almost assure you he's using this fund. He's probably using this. I would use this as a growth and income. He's my inclination is probably saying this is the growth fund. Again, I don't know. I'm just going off what I can ascertain of his investment mix because he says he uses funds that have been around since the 30s and 40s, and there's only a few that have been around that long. I guess MFS has had a fund that's been around. I think that's actually the first mutual fund, MFS. I'd be surprised if we use that one though. Anyway. American Income Investment Company of America is freaking awesome. So I don't care about the 2 stars. I mean, I do. I mean, I ideally want higher stars. I mean, I've done videos and blog posts about why you should use the Morningstar ratings, but in this regard, it's just not that big of a deal because it's been around for so long. Number of years up 68, number of years down 16, and that's what you're looking for. Number of years up and versus number of years down. 5-year average return 9.57. You can hang your hat on this fund, man. Year to date, so look, if you look over the last 10 years, it's been beaten by its category and significantly, almost a full 100 basis points. But over the last 10 years, it's averaged 12.46. So if you're griping about 12.46 because the category is up 13.24, I think you got an issue, my friends. I really do. I'd say, that's not too shabby. 5 years, 8.3. You can see all this stuff. So over the basically since 2000, roughly the middle of 2000, the ICA and Investment Company of America has underperformed. It has. It just has, without question. The S&P 500 has outperformed really over the last 20 years. But again, all I really care about is this right here: 68 up and 18 down years. And if we look, inception 1934. This sucker has been around since 1934. I don't know what we'd have to look at American funds to see what the total returns have been. I will do that here in just a second. So let's go back. You can see. So basically, if we look from the last 20 years. His underwhelmed let's see. It's actually done better more than I would have thought. That's interesting. Okay. Under, better, better. Okay. That's actually kept par with his categories. Relative to the S&P 500, it hasn't. But, and you can tell this is not a booming. If you want to compare this to the S&P 500, you can tell if it's an S&P 500 like fund because it'll have in 2000, it was up where the S&P 500 was down. And then the latter part of the 1990s, this fund, while it did well, it did not do nearly as well as the S&P 500. So that's kind of going to be your growth / I would use this as growth and income. But just look, you go back to, just look at all these years. It's just freaking insane. Just go back. Look at that. 73 and 74 got hammered just like everything else did. Just look at the history of this thing. It's a stellar fund, man. Anyone who griped about this, I just say, I don't know. I don't know what to tell you. I just don't know. But look at that. Nuts. Load adjusted returns over 10 years at 11.8%. So even if you have paid a 5% commission on the front end, you're still getting around 12% over the last 12 years. It's just, it's insane. Let's see. Let's go to American Funds and see. So let me pause for just a second. Here's AmericanFunds.com. I'm under the advisor, but you can go to the you can click on individual investors and 8 decades of consistency. It's invest in primary larger, well-established companies that represent a wide cross section of the U.S. economy. So let's just go real quick to the quarterly fact sheet, and then I'll show you the ICA guide. You can read for yourself. And what you'll find here on the quarterly fact sheet is fund lifetime is average 11.97. Since the beginning of 1934. And that's with its maximum offering price. The highest commission you would have paid, 5.75, is average of 12%. That's Dave's 12%. That's why I think he uses his fund, because it has averaged 12% going back to the history of the fund. It's just, it's nuts. And I don't argue that. I just don't think you're going to get it going forward. I don't argue that it has done that. I'm just wondering if we can see the ICA guide. Let's backtrack here a little bit and jump to fund. Bear with me just a sec. All right, let's go to, so this is called growth and income funds. I'm surprised by that. I would have called it, let's see if we can't do the ICA guide. Let's see if I've done videos on the ICA, right here. Wow, man. right there. ICA Guide Class A shares. And you can download this, and you should. I mean, if you want a history of a good fund that's done historical, it's nuts, man. I guess I view print. This is just a tutorial on investing. If you want a tutorial on investing basics, download this. I'm just telling you, it's freaking awesome. This is where I started to see how just focusing on your last year, it literally is just everything is here is just a piece of just investment gold. There's no other way around that. So I just want to show you and this is the fund managers. They got all these guys in here. These are the fund managers. American Funds does a different, unique place of investing than anyone else does. They give each manager a sliver of the portfolio and let them go on their good and merry way. And so what we'll see here is that ICA invested with dividends, you would have averaged 11.9% going back to 1934 if you would have reinvested the dividends. And yet, I think they say the S&P 500 would have averaged 10.7%. I mean, there you go. All right, so that's anyway, I love that. All right, so let's keep going. Let's keep seeing what we got here. You should order the ICA guide, download it, print it. It's a piece of history. It's literally historical. I love it. All right, so that's one fund I think he has. Let's go to the Franklin Income Fund of America, Franklin FKINX, and he's probably using the ICA as growth investment company America. He's probably using Franklin Income Fund as his growth and incomes, which I think it does get Morningstar ratings of 4%. The fund has been around since 1948. All right, so this fund has been around for a long time. 56 up years, 14 down. I don't know what its total returns are since inception, but it's pretty good. And this is definitely a growth and income fund for sure. All right, so and as you can see why, because it's got 5.17% in yield. So it's going to have a lot of dividend stocks and even some bonds in there. It seeks to maximize income while maintaining prospects for capital appreciation. It invests in a diversified portfolio of debt and equity securities. And again, I don't know what his things are, but when Dave says some of my funds have been around since the 30s and 40s, I have got to assume Franklin Income Fund is one of them. It's just a great fund. I mean, look at this. Green across the board. I mean, just across the board. 2008 got killed. No other way around that. But look, 2001 and 2, it did not get killed. All right, so 2001 and 2, when the markets themselves were down 9, 11, and 22% respectively, Franklin Income Fund was up 20% in 2000, up less than 1, but still up and less than 1% down in 2002. It did get hammered in 2008. I bet they bought some bank loans and stuff. I hope they learned their lesson there. But other than 2008, I mean, we don't have any. We had 8% down in 1990. I mean, just 12% in 1974. That's nothing compared to the market as a whole. We got some down years, but not anything like the market as a whole. But it's just done incredibly well. And even if you paid a front end commission, it's tough to beat this fund, man. It is. But Josh, I know I get it. It's tough to beat the fund. That would be the growth and income fund, I think. So I think AIVSX would be the income fund of Investment Company of America would be his growth fund. Growth and income fund, I would presume, would be Franklin Income Fund for growth and income. See if I have something else I want to say on this. I forgot what it is. Let's go to CWGIX, another American funds, which I think would be his Capital World Growth and Income Fund. I gotta think that's got to be his international, because it's tried and true. Has been around for a long time. You do get paid a commission. The guy, his ELP guy, this fund has been around since 1993. All right, maybe not as long. The American funds has something called the New Perspective Fund as well, but that has a lot of U.S. stocks, about 35% of U.S. So don't do that. But this is another great fund, without question. Oh no, it's only 3-star rating. I don't care. It's stellar. Been around since 1993. 19 years up, 6 years down. And we just go back. It was down 10% last year, 2% in 2015. Got hammered like everything in 2008. Down in 2001 and 2, but not in 2000 and the year 2000, and even 2001 and 2, significantly less than its peers and significantly less than the S&P 500 as well. So just a great fund. The cost after you pay the commission, the fees. Let's see. Let's just say the fees on this guy, like probably 0.8 or something like that. Let's see, where are the expenses? I missed it. Let's see. Don't they show expenses on Yahoo? They used to. Let's find out. Let's go to sustainability. Oh my goodness, it can't sustain. Oh, expense ratio 0.76. Okay, actually, let me go back to the other ones too. Tough to beat that. Tough to beat 0.76 with a broker sold fund. It really is. AIVSX. Let's see what the expense ratio there is. 0.57. That's American funds part and parcel. FKINX. That's the Franklin fund. Let's see what that guy is. It's probably a little bit more expensive, I think, but let's see. 0.62. Yeah. All right, so the last one. So we got growth and income. We got growth. We got international, and we're going to use this one right here as a Fidelity for aggressive growth, FCNTX, the Contra Fund. But Contra Fund is not a broker sold, so I want to show you the Contra Fund track record and then put you on the advisor sold one where the guy can get paid a commission. Fidelity Contra Fund, and this one's been around since 1967. It's just kick butt taking names. There's just no other way around that. Let's see, performance. This is going to be aggressive. It's weird. Look, see, he's got 3-star rating there, and then you got 4-star rating there. So that's odd to me. Okay, whatever. Actually, what is the expenses on this guy? The expenses on this guy, 0.82. And I don't even know if you can buy the Contra Fund anymore. I don't know if you can. He was closed for a while, and I don't know if it is anymore. But we have 38 up years and 13 down years. And so let's go back to, last year was down 2%. 2008, it was down 37%. So it got killed just like the S&P 500. But I mean, look at these returns, man. 32%, 34, 16, 29, 16. I mean, just look now in 2001 and 2, it did lose. It did lose less than the S&P 500 though. So there you go. S&P 500 again was down 9, 11, basic 12, and 22% respectively. This was down 6, 12, and 9. Not so bad. And yet in the late 90s, it did pretty good, man. No other way around that. And then 94 is down a little bit. 99, it wasn't down at all. 1987, I mean, so you can see this. Look, so I mean, had some rough years in there too. But 1973 and 4 is only down 10 and 14% respectively. That's a lot, but it's not nearly as bad as what its peers were. Look at that. So it's just a great fund. It's run by this guy here. Where is the profile? Bill Danoff, as lead manager since 1990. He also owns, so basically using that fund, you're basically buying the investor, and his fund is FNIAX, which is the Fidelity Advisor New Insights Fund Class A. And I think this has only been around since 2003 or something like that. Yeah, 2003. I used to sell this fund because it's built in. So it's like if you're doing horse racing, you buy the jockey, not the horse so much. It's the jockey. So you buy the jockey. Now, look, I'm not a horse racing connoisseur. I just remember my dad used to take me to Pimlico up in Baltimore, and we'd always bet on the jockey. And there's a guy named Kent Desmareau or something like that, who is riding good horses. And we'd bet on him. Now, I don't bet. I could be easily addicted to betting, so I don't do it gambling. But same thing here. If you want to buy the jockey, not the fund name. So you don't buy Fidelity Magellan because the jockey has changed. All right? You don't buy Fidelity New Insights because of the name. You buy because of the jockey, Bill Danoff. You don't buy Vanguard Healthcare Fund. You buy the jockey, Ed Owens. And I don't think he runs that fund anymore, but I don't know. But anyway, that's how it works. See, I just believe going to indexing. But still, if you want to follow the Dave Ramsey model, let's see. So we got New Insight Fund. Let's go to performance. We got 12 years up, 3 years down. 2008 got hammered. Again, as you can see, almost identical to what New Insights did here. So got hammered 37.9%, almost identical. Down a little bit more in 2018 than the Contra Fund was, but anyway. So let's actually, what's the fees on this? I bet it's gonna be higher because it's gonna have a 12B1 fee. Yeah, 1.05. So all right, so let's close this up. I don't know what Dave Ramsey has. I like the idea of what he spouts from an investment perspective. I agree with it unequivocally. You buy aggressive stuff for the most part. You pay a front-end commission if you're going to hire somebody, and you just let stuff be. I completely, unequivocally agree with that. Don't pay fees on a regular basis. But you're paying fees. Yeah, you're paying 12B1 fees. It's 25 basis points for the guy to maintain your account. Will you get the best service in year 5 as you did on the front end when he's getting the big bucks? Probably not. But I don't know. I tell you, some of these guys can build pretty good businesses on 12B1 fees. I'm telling you. The issue comes if they start saying, well, let's get you out of this fund and put you in a C share or a fee-based share. No, you don't want to do that. Once you pay the front-end commission, do not change. You can go from American funds to American funds, Class A to Class A without paying a new commission. That's fine. But don't go from American funds to Oppenheimer or American funds to Putnam because you have to pay the fee again. Don't go from American funds Class A to a fee-based account. That's bad. I'm surprised the SEC doesn't crack down on that because I know that happens a lot. They have to do these mutual fund switch letters while you switch in mutual funds. But the brokers, hell, that's easy to get by. Compliance is okay. That's not good. It's not good to go from a Class A share that you already paid into a fee-based account. That's bad. That's bad news. There's no reason to do that at all. So just keep that back in your mind. So when it comes to my perspective, I agree with Dave Ramsey. I just don't think the idea that you can expect 12% returns, I don't agree with that at all. But the idea of what his funds are talking about, and I'm sure they're not 100% identical to this, I still 100% agree without question. Now, if you want to go to the index fund, which is what I espouse, I agree with that too. It's completely up to you. All right. See you next time. Smash and like and share the video. See ya.